think that there's more downward revisions to come. In fact, I think the 18,000 jobs that just disappeared, that's just the tip of the iceberg. I think more jobs are going to vanish probably after the election rather than before. I guess there's no real reason for them to come clean now when they're trying to, put a lipstick on this pig of an economy. But, the labor market was never really strong. The jobs that are being created, I think the largest segment was government jobs. And these are not the jobs the economy needs. These are non-productive jobs. In fact, they tend to make productive people less productive. So they have to be supported by the taxpayer or, inflation. We have to run larger deficits. The Fed has to print money to pay their salaries. And then they spend that money to buy goods and services they didn't help produce. And it drives up prices. A lot of the jobs have been part-time jobs. In fact, all the jobs, the new jobs, are part-time jobs. And they mostly went to people who already have jobs. So why are people taking on second jobs and third jobs? Moonlighting is at an all-time record high. It's because inflation has so decimated the value of their paycheck that they need a second one or a third one to pay the rent or to put food on the table. So these are jobs that people wish they didn't have to work. But unfortunately, in this weak economy, they do. And I think the unemployment rate, the official unemployment rate, is only low because of all the people that we don't count anymore. If we still measured unemployment the way we did before 1994, we would find that we have a historically high unemployment rate. So the labor market is weak. We'll see when we get the non-farm payroll report. But whatever it is, take it with a grain of salt because it's going to be revised lower at some point, just like we got the numbers on the JOLTS and the numbers that we got today. It was the lowest, I think, in 3 or 4 years. For that number, it was way below estimates. And of course, they went back and they downwardly revised the number for the prior month. And that's par for the course. The government comes out with a number. Everybody focuses on that number. And then a month later, they revise it down. And then nobody pays attention to the fact that what they thought was good news ended up really being bad news. And now they give you another number that everybody focuses on, which again gets downwardly revised the following month. I don't believe that the economy is really growing. I think there's inflation, and so inflation can distort these numbers, especially when it's underreported. But, look at the trade deficit that we got last week, the merchandise trade deficit. It was the worst trade deficit we've had in 1 month if you exclude the 4 months in early 2022, January through April, which were, the reopening of the economy after the pandemic. There was a bottleneck of goods that hadn't been shipped. And so as soon as we reopened, all this backlog got shipped. And so it really distorted the trade deficits. But the one that we just had is the biggest since April of 2022. And, it's going higher. So we've got these record trade deficits. That is not a sign of a strong economy. Strong economy produces more stuff. When you produce more stuff, you don't need to import as much. In fact, you can export more. But the American economy is hemorrhaging red ink. And it's not just the trade deficits, it's the budget deficits that are, record highs outside of the COVID pandemic months. Why is that? If the economy is strong, why does the government not collect enough, taxes to have a lower deficit? The fact is the deficits are high because the economy is weak. So those numbers are not telling the real story. Well, it shows you how ridiculous the Fed is because it claims it's data dependent, but the data that it depends on is irrelevant because it's false and often gets revised. So they really should be looking at market data. I think the most significant data point is the price of gold, which is around $2,500 an ounce as we speak. And it recently hit an all-time record high of, I think it was about 2,530, but 2,500 was a record high. Alan Greenspan, who used to be the Fed chairman, when he was asked about the role that gold plays and whether or not we should, return to a gold standard, which of course he believes we should, but at the time, what he said was that, well, we don't really need a gold standard because we're effectively on one now, because he said that gold was an important way that he knows if his monetary policy is too loose or too tight. He said he looks at the price of gold, which at the time was around $350 an ounce back then. And he said, if gold goes towards 400, I know that I'm too easy. And if it goes down to 300, then I know that I'm too tight. And so I use the market signal of the gold price to know what I need to do with monetary policy and interest rates. Well, if gold is the most important signal of monetary policy, and it's at an all-time record high of 2,500, what should that be telling the current Fed Chair Powell? Its monetary policy is too loose. And he keeps claiming that it's tight. It's not tight. If it was tight, gold would not be making record highs. I mean, Greenspan was Fed chairman, so, why is he wrong and Powell right? He said gold was a key indicator of whether you have the right policy. We clearly have the wrong policy. Powell is getting ready to cut rates when he should be raising rates. In fact, they stopped raising rates too soon. Rates should have gone a lot higher, but they didn't. And now they're about to go down. And that's why gold's at a record high and going much higher. In fact, a leading indicator of the US dollar is the Swiss franc. The dollar is at a 13-year low against the Swiss franc. We're only about 7% above an all-time record low against the Swiss franc. And the Fed hasn't even cut rates yet. And they haven't even returned to QE, which is going to be the next step. In fact, they've already tapered the QE program. They're not doing as much, QT. They're not doing as much quantitative tightening as they used to. And soon they're going to go back to quantitative easing. That's going to be, I think, shortly after they start cutting rates. Because I think what's going to happen when they cut rates is maybe after a knee-jerk reaction, if we even get that, I think you're going to see long-term interest rates move up. And that's going to be very problematic for the economy, for the Fed. And so I think the Fed is then going to have to intervene in the Treasury markets by buying more bonds in order to suppress those long-term rates. And that's going to necessitate a return to quantitative easing, which of course throws gasoline on the inflation fire that the Fed never put out, right? It's still there. It's still burning hot, yet they're going to cut rates anyway. When this century began in 2001, gold was still under $300 and the Dow was about 10,000. And during that period of time, the Dow is up just over 4 times and the price of gold is up just over 8 times. So if they're trying to suppress it, they're not succeeding. Now, it's possible that without some efforts to suppress the gold price, it would be even higher. But I think it's going higher than 2,500, regardless of any efforts to suppress it. I certainly, Wall Street, doesn't understand gold. Big investors are way underinvested, so you haven't seen that. In fact, I put up a graph, I posted it on X, where I showed this massive divergence that just barely turned, which started in kind of late 2022 and accelerated in late 2023, where you saw huge outflows coming from the gold ETFs and a big increase in the gold price. Now, prior to 2022, there was a very strong positive correlation between the AUM of the gold ETFs and the price of gold. Right? As the price of gold went up, more people put money into the gold ETFs. But that changed, where you saw the gold price going way up. At the same time, people were pulling their money out of the gold ETFs, the investing public. So it's been a great contrarian indicator because gold has been going up, even though investors have been selling it, retail investors. An interesting angle, too, is you look at the launch of these Bitcoin ETFs that came out in January this year. Over the last 6 months, Bitcoin is down 8-10%, whereas gold's up 23%, despite massive inflows into the Bitcoin ETFs and massive outflows from the gold ETFs. In fact, all of the gains that Bitcoin has so far in 2024 were in the first 2 months of the year. And I think a lot of those gains are going to be eradicated in the last few months of this year. A lot of people are going to be surprised, but gold is going to end up well outperforming Bitcoin during 2024. It's going to have a better year than Bitcoin, despite all the money going into the Bitcoin ETF. So people are backing the wrong horse. They were pulling money out of their gold ETFs to buy Bitcoin ETFs when they should have been doing the opposite of that. Not that there were any Bitcoin ETFs early in the year, but they should have been selling their fool's gold and buying the real thing. The bigger mistake was cutting rates to zero in the first place. They never should have done that. And they never should have done quantitative easing. As I said at the time, they were making a deal with the devil when they did that. And, the devil's going to come back to collect. It's just a question of time. But because they made that mistake, they created an economy that's completely dependent on all that cheap money, on 0% interest rates and QE. And once you create that dependency, you can't remove the drug that the economy is now dependent on and expect everything to be okay. It's not. You're going to have a massive crisis. Now, it's still better to do that. So the Fed should not cut rates. The Fed should raise rates, even though those rate hikes will produce a massive financial crisis and a huge recession and cause, a lot of seemingly bad things to happen. A lot of businesses will fail, banks will fail, people will lose money, government's going to have to slash spending, which is a good thing, but not if you're counting on that money as part of your income. And bondholders are going to have to be told the truth that they're not going to get their money back. So a lot of bad things are going to have to come out in the open if the Fed does the right thing and keeps raising rates, because rates are still too low. Monetary policy never got tight. Powell keeps saying, we've had this tight policy. No, we haven't. Rates got to 5.25. In what universe is that tight money? And you don't even have to just take my word for it. Look at the credit markets. While the Fed claimed to have tight policy, government debt surged to a record high, household debt record high, credit card debt record high, household savings record low. That is not what you're supposed to get when you have high interest rates. When you have tight monetary policy, borrowing and spending is supposed to come down and savings are supposed to go up. The fact that that didn't happen is proof that the Fed never raised interest rates high enough to do the job. And that's because it knew that it would cripple the economy. So it kind of played lip service with this pretend inflation fight. But even 5.25 was too much, because the reason the Fed stopped hiking rates wasn't because inflation, the battle was won, but because banks started to fail. Silicon Valley Bank, Signature Bank, these banks collapsed, and a lot more would have collapsed had the Fed kept hiking. So they stopped hiking. So they're going to make the mistake now of cutting rates. And the reason that's a mistake is that's just going to allow the underlying problems to get worse. And it's going to really let inflation run wild. And the Fed is going to lose what's left of its credibility. Because what is the Fed going to do in 2025, let's say, when it's already been cutting rates and the economy is now admittedly in a recession, but inflation is now back closer to 9% than the 3% where it is now? And it's clear that it's not going back down to 2. What is the Fed going to do then? Is it going to reverse and start hiking rates again, which will produce an even bigger crash than that had not even stopped hiking in the first place? Because once it gets the market prepared for rate cuts and it has to pull the rug out from under it and surprise them with rate hikes instead, that's going to be even more traumatic for the markets than had the Fed never cut in the first place. I think it's going to expose the Fed as the paper tiger that it is, and the world's going to see that inflation is not going to go away. Inflation is the lesser of the two evils from the Fed's perspective and from the government's perspective. And then that's going to be the final nail in the coffin of the dollar. The dollar is going to collapse. Gold's going to go through the roof. And I think, we're going to finish the de-dollarization process. I think gold is going to reclaim its throne as the primary monetary reserve for global central banks. And the central banks that have been buying gold these last few years are going to be looking pretty prescient, because they're going to have a highly appreciated reserve asset. And a lot of other central banks are going to be chasing much higher gold prices to try to replace, what's left of their foreign exchange reserves, because the dollar, would have collapsed.